Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, let's just unpack a massive, honestly, head-scratching contradiction staring us right in the face today.
It's a big one.
Right. Picture this scenario for a moment. You are pulling up a company's year-end financial statement for 2025. You scroll down to the bottom line, past the operational revenues, and you see a net loss of $86.1 million.
Yeah, $86.1 million.
Not a typo. It is an $86.1 million hole. Naturally, as an investor, your immediate instinct is that the market must be punishing the stock. But then you zoom out and look at the chart. Over the last 12 months, this exact same company is up an astounding 387.9%.
It's wild.
On top of that, it has already gained another 24.4% just since the start of 2026. How on earth does a company bleed that much cash and still see its stock price nearly quadruple?
Well, it really highlights the ultimate paradox of growth investing, doesn't it? The top-line numbers, they often seem entirely divorced from reality until you actually lift the hood and look at the underlying mechanics.
You really have to dig deeper.
Exactly. What we're looking at here is a company navigating a notoriously difficult transition, one that, frankly, destroys a lot of businesses. They're moving from being a speculative developer,
which is basically a company full of geological potential but lacking a massive economic engine.
Right, exactly, into a major domestic producer of critical minerals. So the market is essentially shrugging off that $86 million loss because it's aggressively pricing in a monumental transformative 2026.
I mean, to justify ignoring an $86 million hole, you better be building an absolute monopoly, because 2025 wasn't just a slight operational miss. They pulled in $65.9 million in revenue.
Which sounds somewhat respectable.
It does, but it gets completely swallowed by that net loss. For the average retail investor, seeing a loss that eclipses total revenue, that triggers a survival instinct to just run away.
Yeah, and in a mature, steady-state operational environment, it absolutely should trigger alarm bells. But context is the variable that changes everything here.
How so?
Well, this $86.1 million loss is not an operational failure. It doesn't represent a broken business model or, runaway administrative bloat. It is a highly calculated, incredibly aggressive cash burn.
So they're spending it on purpose?
Very much so. Every single dollar of that loss is being purposefully funneled into building out rare earth element processing capabilities and accelerating the physical development of uranium mines. They are digging the foundation for an absolute fortress. And right now, the income statement just reflects the cost of pouring the concrete.
Okay, pouring the concrete. And the asset they are pouring all this concrete into is the White Mesa mill. People often use that classic business analogy of a toll bridge to describe a company's moat. You own the only bridge between two cities everyone has to pay you to cross.
It's a great analogy, usually.
Usually, yeah, but a standard toll bridge doesn't quite capture the sheer exclusivity of what is happening here. This is more like owning the only high-security quarantine zone or specialized biorefinery in the entire country.
Right, the barriers to entry are just insane.
Exactly. If anyone else wants to process these specific, highly regulated materials, they can't just pave a new road. They are staring down 2 decades of environmental permitting, billions in capital costs, and a relentless regulatory nightmare.
The regulatory moat is staggering. To drop the metaphor and look at the physical reality, the White Mesa mill is the only conventional uranium mill operating in the United States today. Not one of a handful. The only one.
Wow.
But what makes it truly unparalleled is its secondary capability. It's the only facility in all of North America capable of processing something called monazite sands for rare earth recovery.
And for those who might not be familiar with the mining jargon, monazite sands aren't something you'd find on a beach vacation.
Definitely not.
This is a highly radioactive, mineral-rich ore that is incredibly difficult and dangerous to handle. You can't just refine this stuff in a standard industrial warehouse.
No, you absolutely can't. It requires a specialized, fully licensed facility equipped to manage radioactive materials safely.
Right.
And that radioactivity is exactly why the barriers to entry are practically insurmountable for competitors.
Mm-hmm.
If a domestic uranium project or a new rare earth mining initiative wants to process their raw materials locally instead of shipping them across the ocean to foreign competitors.
Which is a logistical and geopolitical nightmare right now.
Exactly. They have virtually zero alternatives. They have to go to White Mesa. When you understand that dynamic, that $86.1 million loss suddenly looks less like bleeding cash
Hmm.
and more like they're aggressively reinforcing the gates to a monopoly.
Building the moat.
Right. They're securing a literal choke point in a supply chain that the entire country has suddenly realized is vital to national security.
So the asset is unparalleled, and the moat is impenetrable. But, you don't quadruple your valuation just by owning a heavily guarded facility. You have to prove that massive volumes of material are actually flowing through it.
Right, you need throughput.
And looking at their targets, they aren't just meeting the baseline expectations, they're completely shattering them.
They really are. They exceeded their 2025 uranium targets, which is a rare feat in the mining sector where, let's be honest, operational delays, equipment failures, and permit holdups are essentially the default setting.
Very true.
But the real catalyst driving this incredible stock surge, including a massive 9.6% volume spike right after their late February earnings call, is their 2026 guidance. It is stunningly aggressive. They're projecting their uranium production to hit somewhere between 2 and 2.5 million pounds next year.
Which means they are essentially doubling their production output in a single year.
Yep. And when you double production through an existing sunk cost asset like the White Mesa mill, you trigger massive volume leverage.
How does that play out for the bottom line?
Think about the underlying mechanics of a milling operation. Your fixed costs, like the massive electricity bills to keep the heavy machinery running, the baseline specialized staff, the rigorous environmental upkeep, those costs stay relatively flat whether you are processing 1 million pounds or 2 million pounds.
But your output is doubling.
Exactly. Because you're spreading those heavy fixed costs over a significantly higher volume of output, the profit per pound skyrockets. Analysts are currently projecting their gross margins will expand violently, jumping from roughly 31% today to over 50% by 2026.
Hitting gross margins over 50% in a heavy physical commodity business is practically unheard of. But here is where the strategy gets incredibly aggressive, and where I have to admit I have some serious reservations.
Oh.
Yeah. They're planning to achieve this massive margin expansion while operating entirely unhedged. That means 100% exposure to the spot market.
That's right.
Isn't operating completely unhedged a profoundly reckless move in a commodity market known for wild volatility? I mean, look at Cameco, one of their major competitors in this space.
Cameco locks in these safe, long-term, fixed-price contracts with nuclear utilities. They know exactly what they're getting paid for their uranium 3, 4, 5 years from now. Why wouldn't you take the safe route, guarantee your massive new revenue stream, instead of riding the daily roller coaster of spot prices?
Well, it looks reckless if you view it through the lens of a stable, predictable market. If supply and demand are perfectly balanced, hedging is exactly what you should do to protect your downside.
But we aren't in a balanced market.
Not even close. That is not the macro environment we're operating in today. The global uranium market is facing severe structural supply gaps. We are in the middle of a massive nuclear renaissance.
Right.
Global demand for steady, baseload, clean energy is surging, partly driven by the immense power requirements of new AI data centers, and there simply isn't enough uranium coming out of the ground to feed the reactors. In a structurally deficient market, going unhedged is the ultimate lever.
Because Cameco might be locked into selling uranium at a fixed price of, say, $60 a pound because they signed a contract 3 years ago. Exactly.
While Energy Fuels is completely free to sell their doubled output at whatever the premium spot price is today, whether that's $90, $100, or $120.
Fixed price contracts build a floor beneath your stock, but they install a very hard ceiling on your upside. By remaining completely unhedged, management is making a highly public, calculated bet.
That the price is only going up.
Precisely. The price of uranium is only going up because the world physically cannot produce enough of it right now. For you, the investor, this strategy provides pure, undiluted upside participation. You aren't just buying a company's operational growth, you're buying direct leverage to the underlying commodity price itself.
Okay, it's a bold bet.
Yeah.
But doubling production and building out complex, rare earth processing capabilities at the same time takes an ocean of capital.
It absolutely does.
And in the small cap mining world, we usually see this ambition play out in a very predictable, value-destroying way. A company announces a massive expansion, they burn through their treasury, they run out of money, and then they issue millions of new shares.
The dreaded dilution.
Yes. They dilute their existing shareholders into oblivion just to keep the lights on, and the stock collapses. How is this company avoiding that classic mining death spiral?
They're avoiding it by engineering what the industry calls a fortress balance sheet. And the scale of it is staggering for a company with this market footprint. They ended 2025 sitting on $927.4 million in working capital.
That is nearly $1 billion in working capital.
Almost a billion.
And looking at the breakdown, they have $64.7 million in pure cash and cash equivalents sitting right there. But what really caught my eye was how they built that war chest.
The debt offering.
Yes, I was looking at their convertible debt offering. They secured $700 million in an upsized convertible senior notes, offering at an interest rate of just 0.75%.
That's an incredible rate.
In today's macroeconomic environment, securing almost $750 million for less than 1% interest feels like a typo. How did they pull that off?
It comes down to the mechanics of convertible debt. Institutional lenders are willing to accept a practically non-existent 0.75% interest rate because of the convertible feature.
They want the equity.
Right. They aren't in this for the yield. They want the embedded call option to convert that $700 million of debt into equity later on if the stock continues its massive upward trajectory.
So it's a bet on the growth.
It's a massive vote of confidence from institutional money. They believe the equity upside will vastly outperform standard interest yields.
It's a brilliant maneuver. They are essentially using incredibly cheap, almost free debt to buy the rocket fuel for this expansion rather than selling off pieces of the rocket itself by issuing straight equity.
Exactly.
They don't have to dilute you, the current investor, because Wall Street just handed them the cash for next to nothing. And it's worth noting that they pay 0 dividends and execute no share buybacks. Now, normally, a dividend investor might look at $1 billion in working capital and ask why they aren't getting a cut.
Sure, but returning capital to shareholders at this specific stage of their growth cycle would be a massive strategic error. Every single dollar they hand out as a dividend is a dollar they aren't using to solidify their monopoly.
So it all goes back into the business.
They are relentlessly reinvesting all available cash flow into vertical integration. They want to own every step of the process.
Which makes sense.
That nearly free debt allows them to execute on high-impact growth initiatives, like perfecting the rare earth expansion at the mill and accelerating the development of the Pinyon Plain Mine without the immediate crushing dilution risk that plagues almost every other peer in this capital-intensive industry.
Okay, so we have the ultimate monopoly asset, a highly aggressive, unhedged strategy to capture rising prices, and a fortress balance sheet fueled by practically free institutional money. It sounds like a flawless machine.
On paper, it does.
But a strategic shift of this magnitude rarely happens without internal friction, and this is where we start seeing some real fractures in market sentiment.
Yeah, the leadership change.
Exactly. Just recently, the stock took a 6.35% hit following the announcement of a major CEO transition. Now, a 6% drop isn't a catastrophic crash, but it clearly indicates retail panic, or at the very least, a moment of deep uncertainty testing the resolve of the market.
Yeah. Transitions at the top always introduce volatility. The market inherently despises uncertainty, and changing the captain while the ship is undergoing a massive overhaul is going to rattle some nerves.
Oh, sure.
But if we break down the actual facts of this transition, the institutional sentiment is largely categorized as bullish but disciplined. The outgoing CEO, Mark Chalmers, isn't just pulling the ripcord, taking a golden parachute, and disappearing.
Right. He is staying on board as a strategic consultant for 2 full years.
Yes.
Which is a massive signal of insider alignment. He has skin in the game and wants to ensure this transition doesn't derail the momentum.
It shows a very deliberate, continued commitment to the company's long-term operational roadmap. Now, the new CEO taking over on April 15, 2026 is Ross Papu. And this is where the underlying strategy really comes into focus. Papu brings over 35 years of hardcore mining experience to the table, but his most notable background is heavily tied to rare earth elements. Specifically, he played a pivotal role at Molycorp.
Molycorp. For those who follow the sector, Molycorp is a legendary name. They were the former heavyweight champion of U.S. rare earths.
Exactly.
So this raises a genuinely critical question, and it's something you need to be actively asking yourself as you evaluate the stock's future. With Papu's deep, specialized rare earth background, is Energy Fuels subtly shifting their identity?
It's a valid concern.
Are they pivoting to become a Western rare earths heavyweight at the expense of their foundational uranium focus? Could they be getting distracted from the core nuclear engine that drove that 387% gain in the first place?
That is the exact question driving the current market anxiety, and it's almost certainly the primary reason we saw that short-term 6.35% dip. Retail investors worried they were losing their nuclear focus.
But what about the institutions?
Well, if you analyze the institutional reaction, the smart money is looking completely past the leadership change. H.C. Wainwright recently raised their price target to $27.25, specifically citing the company's pivotal 2025 developmental progress.
Okay.
Goldman Sachs is looking even further ahead, placing a $30 price target on the stock, recognizing the totally unique advantage of their domestic uranium-vanadium mill.
So they aren't worried.
The institutions don't view Bapu as a distraction. They view his appointment as the final piece of a necessary dual-threat strategy.
A dual threat meaning they legitimately believe they can dominate the uranium fuel cycle and the complex rare earth supply chain simultaneously.
Yes, exactly. The uranium business is the foundational cash-generating engine. But rare earths represent the high-margin, downstream processing opportunity of the next decade.
Because the process is so difficult.
Right. Think about why rare earths are so difficult.
Mm-hmm.
They are all chemically identical elements. You can't just melt them down to separate them like copper or iron.
You can't just stick them in a furnace.
No, to separate rare earths into usable individual oxides requires thousands of sequential stages of highly volatile solvent extraction. It's a grueling, complex chemical nightmare.
And FAPU is the expert in that nightmare.
VAPU is there to master that specific nightmare. The U.S. government is highly motivated to secure critical minerals independently of foreign adversaries. This CEO appointment signals that the company is positioning itself to capture massive geopolitical tailwinds.
By offering a fully domestic, fully secure supply chain for both nuclear fuel and advanced defense materials.
Exactly.
The narrative is incredibly compelling. I mean, the asset is a monopoly, the debt is virtually free, the new CEO is a veteran of the exact complex chemistry the government desperately needs, and the major banks are raising their price targets.
It's a strong setup.
It almost sounds too perfect. So what is the catch? Because in the markets, there's always a catch. We have to explore the bear case and understand why this is not a guaranteed home run.
Well, the primary catch is the valuation multiple. It is incredibly steep. Right now, this stock trades at a forward price-to-sales ratio of 27.80x.
Wow. Just to put a 27.8 times sales multiple into context for a moment, that is a multiple you usually see attached to hyper-growth Silicon Valley software companies, not heavy industrial mining operations.
Definitely not.
What does the rest of the mining industry look like right now?
The industry average price-to-sales ratio is sitting at just 4.81x. Even Cameco, their massive, highly successful competitor, is trading at 18.27x.
So they are way above the rest.
So at nearly 28 times sales, the market has already priced in absolute near-perfect execution. Investors today are paying a massive premium for the rare earth solvent extraction facilities that are still being built and the doubled uranium production that is expected tomorrow.
Pricing in perfection is dangerous.
Very. If there's even a slight operational hiccup, a delayed permit, a supply chain issue with mill equipment, that lofty valuation multiple can compress violently.
Because the execution risk here is paramount. We cannot forget that $86.1 million net loss we discussed at the very beginning. The cash burn is very real, and it is happening right now.
It is.
They have the $1 billion in working capital to survive the burn, but they are spending it rapidly to build out these complex capabilities.
And that leads to the second major risk, which is the inherent danger of the dual strategy itself. Splitting your corporate focus and engineering talent between ramping up physical uranium mining and perfecting complex rare earth chemical separation is demanding on a level few companies ever attempt.
It's a lot to juggle.
If they hit unforeseen delays in perfecting that solvent extraction technology, or if there is a sudden, unexpected dip in global uranium spot prices,
then that aggressive unhedged strategy suddenly becomes a massive liability, and those projected 50% gross margins get crushed overnight.
exactly the danger. If spot prices drop, their unhedged leverage accelerates their losses. If the rare earth technology is delayed, the massive cash burn continues month after month without the expected high-margin revenue offset.
And the stock tanks.
When a stock is priced for perfection, any deviation from the roadmap triggers a sharp, painful derating.
So synthesizing all of this for you, the investor, we've navigated the aggressive cash burn, the unparalleled monopoly of the White Mesa mill, the massive production targets, the unhedged leverage, the new rare earth-focused leadership, and the very real execution risks of a steep valuation. Where does the final scorecard actually land?
The final investment thesis delivers an 8 out of 10 bullish score. There's exceptionally high conviction regarding the sheer quality of the White Mesa asset and the massive macro tailwinds driving both the nuclear renaissance and the critical minerals boom.
Okay, an 8 out of 10.
However, that bullishness is tempered by the steep 27.8x valuation premium. The target horizon here is absolutely not a quick swing trade. It requires a disciplined, long-term hold of 12 to 18 months.
Because it's going to take exactly that long to see if that aggressive 2 to 2.5 million pound uranium production guidance actually materializes, and if the complex rare earth solvent extraction actually works at commercial scale.
Right. The entire thesis hinges on flawless execution over the coming year. To summarize the core takeaway, Energy Fuels is the only U.S. integrated player currently positioned to capture the dual upside of both nuclear energy demand and the critical minerals boom simultaneously.
It's a very unique position.
They are executing this strategy backed by nearly $1 billion in working capital, providing a very rare combination of maximum upside leverage and robust financial safety in a historically volatile sector. You should anticipate some turbulence around the April CEO transition, but the play is to hold for the structural, long-term supply deficit in the market.
Excellent summary. Now, before we wrap up, I want to leave you with a final provocative macro question to ponder, something that stretches beyond the balance sheets and the price-to-sales multiples we've discussed today.
Okay, let's hear it.
As the United States government becomes increasingly aggressive about mandating domestic critical mineral independence and securing localized nuclear fuel supply chains, what happens if this company actually succeeds at everything they're attempting? Right. If they truly become the sole unhedged choke point for the materials powering our electrical grid and our advanced defense systems, at what point do they become too critical to national security to simply operate as a standard public company? Does the U.S. government eventually feel compelled to step in, heavily regulate, or even secure them as a protected strategic national asset?
It's a fascinating geopolitical thread to pull on. I mean, if you successfully build the only fortress in the country protecting the materials the government desperately needs, eventually the government might decide they need the keys to the fortress.
Exactly. Something to heavily consider as you review your own portfolio allocations. Thank you for joining us today, and remember to keep building smart wealth.